and welcome. India's Monetary Policy Committee is set to announce its decision on Thursday, and it appears to be a bit of a no-brainer that the MPC will continue to maintain a status quo on the key lending rate. In fact, all 41 economists polled by Bloomberg expect the MPC to hold the repo rate steady at 6.5% on Thursday. That's not to say that Thursday will be bereft of any action. Will the MPC sound a tad less hawkish than we've seen all of the past year? What can we expect in terms of liquidity measures from the central bank? To answer some of these queries, I have with me Dhiraj, economist at ANZ Research, and Madan, Sabnavis, chief economist at the Bank of Baroda. Thank you so very much to both of you for taking time out for us today. So, Madan sir, I'd like to begin with you. What are your expectations going into this policy?
Yeah, as you have mentioned, we are not expecting any change in the repo rate or even the stance for that matter. In fact, what would be of interest is that if the RBI has something to say on the GDP growth forecast for 25, I think that would probably be the novel factor. There is, of course, certain kind of guidance which is given by the RBI on the course of inflation. But to my mind, between last time when the policy was announced and today, I don't think there have been any significant factors either on the food front or even on the core front to justify any kind of change in their forecast, which they made of inflation right up to the third quarter of next year. So therefore, to my mind, there will be no change in the repo rate or in the inflation forecast. But in terms of GDP forecast, I think based on the fact that the NSO had brought out a forecast of 7.3% for last year, and the government has given its own projection of 10.5% in nominal terms in the budget. So there could be some kind of a forward-looking number provided by the RBI, especially on the fiscal 25 growth number. There could be some kind of an upward revision in terms of 23-24, where the RBI pegged growth at 7%. But again, here, I think the RBI will just assume that the growth for 23-24 is 7.3%. So no real surprises out there. And even in terms of the overall language, it would be more or less what we heard last time, because the RBI is all very cautious, it doesn't give anything much away. It's going to continue to say that it's going to regulate liquidity and make sure that there is no shortage of liquidity. And the tools which has already been mentioned has been the VRR and VRRR, which will continue to be used in the coming months too.
Sure. Okay. So Dhiraj, taking the conversation forward from where Madan sir's left it at, the broad consensus appears to be that not just the repo rate, but the stance also will be continued to maintained as is. However, we have seen the liquidity deficit, worsen in the past month ever since the last policy. What can we expect in terms of liquidity measures?
Look, I think the RBI language on liquidity is not going to change very much. So let's take a step back and understand what they're trying to do. I would first want to clarify that the Reserve Bank of India has never preferred a very, very large liquidity deficit, even though they have been fighting high inflation, right? So because along with the inflation fight, they also have to ensure that they are meeting the productive needs of the economy. In the last month, what happened was a combination of some seasonal as well as one-off factors. The currency buildup tends to be stronger during January to April, May, and given this is going to be a national election year, this tendency could be even stronger. That's one. The second bit is that we witnessed some outflows on the FPI account, largely on account of equity outflows. And thirdly, there was an unexpected slowdown in the government spending. So all of these three factors in combination meant that the liquidity deficit, which the RBI was broadly maintaining in the range of 0 to 1 trillion, widened above that, and which was why, the overnight call rate shot up above the MSF rate, so on and so forth, which got a lot of people thinking, with the RBI infusing liquidity, does it mean a de facto change of stance? My view is that it is not. It was some temporary factors which the RBI alleviated, and some of them will die down on their own. So I think no change of stance. And in terms of liquidity, they will continue to maintain liquidity in appropriation with their stance, which remains a withdrawal of accommodation.
All right. So you've mentioned, you've laid out a whole host of factors that was responsible for the liquidity deficit that we saw. Can we expect this to ease going forward?
Well, I think that, as the Reserve Bank of India becomes somewhat more comfortable with the inflation outlook, there is a possibility that they may begin preferring a somewhat narrower liquidity deficit, but that remains to be seen. Of course, inflation outlook, as Madan mentioned, they would be also giving out the inflation outlook for Q1 of the next year, 2025, and where that number lands will also be critical in us understanding, what kind of inflation trajectory they're looking at.
Got it. Okay. Madan sir, I do want to ask you about high frequency indicators. We've, of course, seen economic activity continue to remain resilient and the economy performing better than what was expected at the start of this year. What's your reading of the economy at this point? And we have seen a little bit of easing post the festive season. Would that be correct?
No, I think that is right, because there have been two factors which have come in the way of the kind of buoyancy we saw in the first 7-8 months. One is, of course, the pent-up demand phenomenon which we saw post-COVID, something which we first saw in the manufacturing sector. Later on, it came in the services sector. So I think that's one of the reasons why the PMIs have been very buoyant, and that's something which we're seeing also in terms of the overall GDP forecast for the year at 7.3%. We, of course, at Bank of Baroda are looking at a number still of 6.6, 6.7%. I think there's a downside to it. There are reasons for it. I won't get into it right now. The second factor, in terms of the buoyancy being moderated a bit, has been consistently high inflation. Because we should remember that inflation has been high ever since the pandemic came to an end. We first had global commodity prices going up, and then we saw some bit of domestic factors pushing up the prices of food items, something which continues even today. So I think the real purchasing power is something which has been affected, and that's one of the reasons why we have seen the rural demand has been the missing block in this entire story. And even today, when you're looking at the commentaries put forward by corporates for the third quarter results, especially in the consumer goods sector, it's almost the same kind of a narrative we are seeing, where the rural demand has not picked up. And even within the urban demand, we have seen that it's the premium products which are doing better than the regular products. So all this means that inflation has definitely come in the way of demand, and that's something which will probably continue till the end of this financial year. Hopefully next year, that's the next financial year, fiscal 25, when inflation starts moving downwards, going by the RBI projections, but that would probably be only in the second quarter, there could be a revival, a more broad-based revival, especially in the consumer space. Today, it's more in industries which are infrastructure related, which are doing very well.
Okay, I do want to ask you a little bit more about the rural demand condition. We've seen a whole host of high-frequency indicators giving a little bit of a mixed picture. In recent weeks, is there reason to believe that there has been a little bit of an uptick? Even going by market commentary that you mentioned of FMCG companies, for instance, things do appear to be looking up in comparison.
No, I think it is in comparison with previous quarter, maybe, yes. And maybe there is more a case of saying, if I'm looking forward, when I say forward, meaning for the fourth quarter, I think one does expect that while there could be certain kind of a shake-up in terms of Rabi prospects or Rabi crop, certain crops, like especially pulses. But otherwise, if you look at the main crop like wheat, I think the sowing has been on par with what happened last year. So there is reason for one to believe that there could be a bit of revival in rural demand. And also, as we head towards March and April, I think there would also be a case of the second marriage season, which takes place in Hindu society. And that is something which could also be adding to demand. So there is a bit of cautious optimism which is there when we are looking at rural demand. But my sense is we need to see overall tempering of inflation for this to be more broad-based. And the other thing in the more medium term is that we need to see more meaningful jobs created, which creates that kind of income where we can have people even at the bottom of the pyramid or the lower areas of the pyramid to add to the consumption spiral. Because today, for example, the RBI uses data like tractors and two-wheelers to be representative of rural demand. Here, the picture is just about stable, not really showing major signs of a pickup. But as I said, one could always be optimistic that post-Rabi harvest, which would start in the month of March and carry on till May, there could be a certain kind of an acceleration out there.
All right. Oh, with that, it's time to slip into a very short break, but stay tuned. We'll be right back with more on this. Hello and welcome. You're watching a special on NDTV Profit. We are a very short while away from the last monetary policy for the ongoing fiscal, and I'm in conversation with Dhiraj Nim and Madan Sabnavis for more on their expectations from this policy. So, Dhiraj, we've seen the interim budget take place a few days back, and it's been a positive on a whole host of fronts. Fiscal consolidation, also lower than expected borrowing. Going forward, how do you see the 10-year GSEC, for the next few months? Can we expect it to remain range-bound?
So I think the budget was a clear positive for the bond markets. Of course, the major surprise was the cutback in the gross borrowing program, even though the net borrowings were kept where they were. But the overarching theme was the classic fiscal prudence and in the commitment to fiscal conservatism that really surprised the markets very, very positively. Now, going forward, of course, I think even regardless of that, the bond market dynamic is something which is tilted in the positive favor of the benchmark yield or the IGBs for this year. And there are many factors supporting that. The first is, of course, we expect at some point in 2024, the Reserve Bank of India will undertake the rate cutting cycle. The second factor is the increasing foreign demand because of the index inclusion. And the third bit, we expect at ANZ Research that, GDP growth will slow down in FY25 quite notably to around 6.2%, which should mean that the loan demand should also cool down. And, the incremental loan deposit ratios are already easing, which should mean that there should be, some improved appetite for bonds from the onshore market participants, especially banks. And therefore, we think that the bond market dynamic is improving, especially on the demand side. And with such supply side conservatism or discipline, of course, there remains downside risk to the bond yield.
Okay. Mr. Sabnavis, is that broadly in line with your view as well?
So actually, Pallavi, when we started off just before the budget, I would have felt that a 10-year bond yield would remain in the region of 710, 715, maybe even 720. Because we were penciling in the fact that if the RBI does reduce the repo rate by 25 to 50 basis points, that would be probably only in the second quarter onwards when the inflation rate came down to 4%, then we could be ending the year at something like 6.75 to 7%. But I think the announcement made in the budget has definitely been something which has had an influence on the market, a very perceptible impact, where we actually saw the 10-year yield coming down from 712, 714 to 74, 75. Even today, as we speak, I think sometime back, it was around 76, 77. So therefore, I think we will remain in this range of 7 to 7.10, even before we have any kind of repo rate cut. And I think the important thing out here is as to what would be the RBI's commentary. What exactly would it be saying? What exactly the market picks up from the language which the RBI is hinting at? I think that is something which is going to drive the yields. Another factor is that one is also expecting there would be a new 10-year benchmark which would be announced, given the fact that we have crossed 1.5 lakh crores of outstanding securities in this particular benchmark. That itself normally has a tendency for yields to move down by around 4 to 5 basis points. So keeping all these factors in mind, I think we could be expecting a lower range. But what we have seen even till last week was there was a kind of an inversion taking place where the short-term yields were being driven more by the liquidity situation, which of course has improved quite dramatically in the last couple of days. So if you look at the net deficit has actually come down to 1.2 lakh crores yesterday, compared to what it was over 2.5 lakh crores. So I think this kind of an anomaly may probably remain for some more time, but definitely the trend is to move downwards. I'm not even bringing the factors which Dhiraj has spoken of in terms of the economy slowing down. We actually think the economy may do better in 24-25. We have a growth rate of 6.75 to 6.8%. So that may not actually translate to a slowdown in growth in credit. I think the private sector investment is something which is going to pick up, not in a broad-based manner again, but in a limited manner. But okay, we will still be in this particular kind of range. So that's what our view is.
Okay, so Mr. Sabnavis, I do have one last question for you. So, we have seen mixed indicators come in as we've discussed during the course of this show, especially from the rural sector. And a lot of the conversation has now any which way shifted to when the Fed and the RBI will cut rates. So, do you think that when the RBI does that, that could also be an additional boost to the economy at that point? How much would it be expected to benefit?
Yeah, actually, I'm not quite sure that when you have a cut in the repo rate, whether it's going to lead to an upsurge in terms of demand, because I think the way RBI could be looking at it, we actually don't know what exactly goes into the RBI's mind, but I would say that we're looking at terms of some kind of a real inflation rate. So when you see the inflation number comes, the real interest rate, sorry. So when inflation comes on, maybe the real rate is something which gets adjusted. Because if you look at what's happened since 2020, we had a pandemic, we had the repo rate go down to 4%. That did not really lead to an increase in growth and credit. And today, when we're talking of a situation where the repo rate has gone up from 4 to 6.5%, we haven't really seen growth in credit slow down. We are still running on a Y-on-Y basis. We're still clocking a number of around 20% per annum. So my sense is that whatever has happened from 4 to 6.5% is a kind of a correction which has taken place, because historically our average repo rate has been in the region of 6.5%. If you contrast this with the Federal Reserve, I think the kind of cuts which come out from the Federal Reserve will be sharper, and that will also have a more perceptible impact on the overall economy, which could be then something which could be expected to revive. Though I think there's always a counter view saying that the cutting of rates by the Federal Reserve may not actually lead to growth. People are still looking in terms of stagnant growth, if not lower growth rate. But we'll have to see how that really plays out in the American economy. But definitely for us, I think lower rates at the margin will be benefiting, especially the vulnerable classes like your MSMEs, maybe your home loans. I think the retail and the MSMEs are going to benefit the most. But from the point of view of the corporates, I really don't think that could make too much of a difference. They'll be looking at overall demand conditions before they decide on the investment plans.
That's a fair point. Dhiraj, do you want to quickly jump in with your thoughts on when you expect the RBI to cut rates?
Look, my baseline forecast is that the Reserve Bank of India will start cutting the rates somewhere around early Q3. Hoping that the fourth quarter, hence, inflation would look benign enough to be able to do that. Now, the only risk to that is, if food disinflation quickens pace, it's going so far as per expectations, there's a risk that the rate cuts could start sooner. Now, as far as the Fed is concerned, look, I'm not particularly concerned about the Fed's rate cutting cycle as long as the market is convinced that the next move from the Fed would be a rate cut. And there's a decently deep rate cutting cycle in the price for the market. I think the Reserve Bank of India will have the luxury of being solely focused on domestic growth, inflation fundamental as far as their monetary policy goes. So yes, early Q3 is when I'm thinking the rate cuts begin in India, and I think about 100 basis points of total cumulative reduction in the policy repo rate. And as Madan said, it's largely from the perspective of keeping financial conditions steady to be supportive of growth, not necessarily to make the monetary policy extraordinarily expansionary. So it is to adjust the real policy rate so that the financial conditions in the economy do not become tight and hurt growth. So that's my view.
All right. Thank you so very much to both of you for taking time out for us today. Well, the RBI Monetary Policy Committee is set to announce its decision on Thursday. And while the expectation broadly is that a status quo will be maintained on the benchmark lending rate, and the stance will also continue to remain as is, we're still going to be watching out for a whole host of cues, what the RBI has to say on macros and its commentary on liquidity. Stay tuned to NDTV Profit, and we'll continue to bring to you all of the action from the RBI on Thursday.